Yes, good morning to everyone. Welcome to yet another session. This is 3rd of May 2025. And exactly about a year before we did the part 1 of gold. And this is the part 2 of gold. I mean, very, very interesting times and very interesting data that we put together. And I'm so excited to share all this with you. So, having said that, friends, for the ones who are joining us the first time, and I like to repeat this every time, this is called the Multimillionaire Forum. We do this thing on the first Saturday of every month. The intention is to pick up a topic which is relevant, sometimes from your suggestions and sometimes otherwise what we feel is happening around us in the world. Pick up that kind of a topic, talk about it, put some ideas on the table. No recommendations of any sort, no investment advice of any sort. But what happens is it becomes a great discussion and something to get sensitized about. And there's so much to learn in this world of finance, and this is just our little endeavor in that direction. So let's have the presentation. Let's get started with gold part 2. And I mean, it's a very opportune time because we are just standing on a very, very interesting movement of gold. We just made history, right? In India, especially, because in India, the 100,000 mark or 1 lakh mark is something that most of us about 10, 15 years back did not even imagine. I mean, forget us. Even the Reserve Bank of India did not think that gold and silver would touch these kind of levels. Otherwise, they would probably not have launched the sovereign gold bond schemes. We all know what is happening to that. Anyway, if somebody wants to know more about that, then we'll talk about that later on in the Q&A session. But friends, history has been made. Gold has touched 1 lakh for 10 grams. Just imagine 10 grams, and this is the price. So it's absolutely insane, right? Silver, basically 100,000 a kilo. I mean, that's the kind of rates that we are looking at. So in May of 24, 4th May last year, on the first Saturday of last year, 2024, we did this session saying it is time to invest in gold. And that's the question we raised and put it on the table. The answer is obviously there in front of us. In May of 25, the question before you is, are you willing to invest now or are you still waiting to invest, right? So that is what we are trying to answer. And there's a lot of data, very interesting stuff which we found and which we will share with you as we move along the next 20 or 30 minutes. Standard disclaimer, as we have in every edition of the MMF Forum, this video is only for educational purposes and we are brokers, distributors. There's no product recommendation and there's no investment advice in this. And of course, you must do your own research before making any decision based on what you hear today. So let's take a summary of 24. What has happened in the calendar year of 24? As you can see, we've had a fabulous rally. I mean, after a very, very long time, we have seen that gold has actually been making and breaking records in 23 and 24 and probably 25 also, and maybe in the years ahead to come. So we had about a 27% kind of a growth that we saw in gold. And this is exactly point to point, yeah, from the 1st of January 24 to the 20th of December, 30th of December 2024. That was the last trading day of 2024, right? So that's just as a matter of information that this is what has happened, just to make a recap. Okay. Now, what is happening is there's a lot of data which is floating around all of us that in the last 20 years, there is comparisons that have started, whether gold is a better investment or is Nifty or, is the stock market a better investment. And this always happens from time to time. But I would say that this is nothing more than entertainment value. But let's look at it and let's, of course, study it a little bit. So 20 years, this is something we found from Money Control. And it's a good, fair piece of data. 20 years, it said gold did 12% and Nifty also did about 13%. And on a last 10-year basis, of course, Nifty outperformed. Nifty did about 12.78 versus gold did 9. And in the last 5 years, gold has done 16% and Nifty has done 13.95 or 14%. But please do not get swayed by this data. This, of course, this does not mean that, there is a case to this. Just this data, yeah, this analysis doesn't mean that one must stop investing in the stock market, start looking at gold. See, something crazy has just happened. What has happened is we have seen a massive spike happening in gold. Okay, and when that spike happens, or when something moves about 20 or 30% in a very short span of time, in about 2-3 months, okay, what will happen is suddenly you will see that that particular asset category is looking better than everything else, but that is momentary. By the way, sorry, Sangeeta, just keep that gold chart on a monthly basis ready. I may want to refer to it some point of time, so just keep it ready in your screen. Okay. And if it's already ready, then I want to show it right now, if it's possible. Okay, I just want to talk about the spike. You see, the point, that the thing is, when you see things like this, where suddenly, here, this kind of a thing happens, where gold is 16%, Nifty is 14%. So all the people who want to sell gold suddenly start talking a different tune. But we have to be just a little more educated about this whole thing. So if you have it, we see it now. Otherwise, we can move on to it as we move along. So let's sort of understand, why is gold rising, okay? Whenever you're ready with the chart, just throw it up on the screen, okay? Why is gold rising so much, and why is it rising so extraordinarily? Okay, see, the basic thing that you must understand is, and we all must take cognizance of, is that gold is where it is. Nothing has changed in gold, okay? Remove these parabolics. Nothing has changed in gold. So gold as a metal has remained the same. The amount of mining that the miners are doing in terms of gold pretty much remains where it is, as it is. So what has happened is, gold suddenly has had a massive spike. Okay, compress the graph. Look at this little movement of gold. Okay, this particular one. Okay, I just want you to highlight your attention to this move. Can you see? And what was this time? Can you tell me what was the date here? This was November 22. Okay. And what was the date here at this point? This was November 23. Okay. So, yeah, almost the end of this year. Now, from here to here, 1 year and a couple of months over it, can you please measure and tell me how much has it gone up by? Yeah, from that point. Okay. How much? 87%? Yeah, 87%. See, when you say calendar to calendar, it was 27, but the 5 months of this year. Now, can you just go to the starting of 2025? Okay, this year's starting of 2025, January 1. Yeah, from that point to now, can you please measure and tell me how much have we grown up by? About 20. So about 28, 29%. So 29% here, 27 of the last year. That obviously makes it 56%, and a couple of percentage points from the months of 2023. So stupendous rise. It's almost like 100% move which has happened. But make no mistake, okay? Compress graph even further. It's also pertinent because we are talking in terms of this rise. We must also understand. Okay, stay here. Okay, okay. Compress more a little, please, and remove the right hand side. Click here. Remove this. So the whole screen fills up with gold. Can you? Yeah, very nice. Fantastic. Reduce, decrease a little bit. So we have a much better view. Everybody can see gold. Pan the entire thing a little upstairs. Go a little bit up. Okay, very nice. Good, good, good. Stay there. Now, so this is some recorded data from 1970. This is 1970, 1970. Okay, this is where you are. So the point to note is that this is the recorded history. Look at this point. From this point, 1970 to what is this point? 1975. 5 years. Just measure how much was the growth. Yeah, approximate is okay. It was about 400 and some 30 odd percent. Okay. The next growth that happened from 1976, from this point to this point. Please measure. Okay, this was another 800%. Okay, absurd kind of growth, right? Okay, now, what was this point? What was this date? This was January of 1980. Friends, now this is where you must take cognizance, okay? And this is why we must not get fooled by what we just saw a minute ago, where suddenly everybody's talking that gold has done CAGR of this much and the Indian housewife is like a much better fund manager than most of the fund managers. I mean, we've seen all these kind of statements coming in. 1980 January gave all the way up to this point. What was this point? 2008. 2008 or 2005, maybe this point here. Okay. 25 years, friends, gold did not move at all. In fact, it went down, as you can see, and then came back up to the same level. You see? And then, of course, this was a little bit of a rally that started off from this point and went up to this point. When was this? 2002 and all the way up to what was this year? 2011, right? Okay. But then again from 2011 to as much as 2023, another 12 years of zero performance. Okay, this happens. So my point is, and what one must understand is that gold rises, it moves up, it spikes up, not because something fundamentally is happening good for gold. It is happening because there is a lot of uncertainty in the world. There is a lot of anxiety in the world. There is a lot of fear. There is something which is not okay in the world as it exists. And at that point, every time gold has had a spike. And as we move along, we'll show you some more diagrams. But remember this, gold is spiking, gold is rising because something is not okay. Okay. Now, let's go back to our presentation and let's see a few more pieces of data. So why is gold rising? We were talking about that. First and fundamentally, as I was saying, it is in some sense, there is an economic relationship. Something is not okay, like what I was just saying. So every time there is a little bit of fear, uncertainty, pandemic, global sort of failure, banking failures. Now, what do we remember from our very recent past? The immediate past was the pandemic, and we saw gold outperform during the pandemic. The previous time to that, when did this thing happen? We saw it during the housing crash, the 2008, the US housing crash. At that point of time, there was a movement that happened in gold. And of course, there was a great time after the crash of America. It was a great time to invest in equity also. But basically, that was the time gold essentially peaked. And then of course, there are, the recession of 87. And then there was, as we keep going back into history, we will see numerous occasions where it was a little bit of a spike in gold because something was not okay. And 1944 was almost historic. Some of you might know why, but if not, we will come to that in a bit. Okay, let's move. The other reason for gold moving up was de-dollarization. Now, this is something that America doesn't really like at the moment. Okay, they don't want that the supremacy of the dollar goes away, that dollar loses its status as the reserve currency, so on and so forth. We spoke at length about all of this last year in that presentation. So I'm not going to repeat all the things that we spoke about last year, essentially all of the petrodollar sanctions, printing and all of that. But what is happening right now, this big red triangle, and that's because of the tariffs and the trade controls and the trade wars that we are seeing. So what has happened is USA had a sort of a debt ceiling, okay, a ceiling which says that you cannot borrow beyond a certain level. So it's like saying that the bank comes and tells you, your banker comes and tells you that look, Mr. Javeri, that you cannot borrow more than 5 crores, for example. That's your ceiling. Okay, for your business, for your trade, for everybody, there's a certain limit. It's called an OD limit. It's called your sanction limit or your eligibility limit, whichever way you want to think about it, right? So there's a limit. So US Parliament, the Congress passed a limit saying, okay, on the 2nd of January, there's a ceiling. We will not go beyond this. But, well, the ceiling was busted. Literally every day, America is printing money. And so much so that today, investors across the world are basically losing a little bit of faith in the US dollar. So, it's like this. So what is happening is over the last so many years, USA has pretty much not manufactured anything, or most of the factories, another way to say it is most of the factories have moved to other parts of the world, essentially China. So for the last so many decades, China has built so many of these skills and resources, processes, methodologies, factories, machinery, and all of that, to produce goods, and right from very low cost to very, very premium and luxury goods as well, and supplying to the whole world. So all along, USA is like a situation where sometimes we see our kids and they just want to buy gadgets and they want to buy the latest iPhone and the latest television and then the latest iPad and the latest computer. So it's like this kid who wants to buy everything latest. So what's happening is they're not manufacturing anything, so they're buying everything from China and from the rest of the world. And to buy, you are paying your own currency, US dollar, because that's the currency of trade in the world. That's the reserve currency. That's the global currency. So you pay them in US dollars. Okay. So first I buy, let's say I buy this pen and I give China or the buyer, or sorry, the seller some US dollars. Then after a while, I come and say, listen, I want to borrow more money because I want, I want money in my country to run my country. So I again, put up an auction and I tell Japan, China, Russia, India, everybody that, hey, these are US bonds. And obviously, reserve currency is the greatest and the safest currency in the world. So I want to borrow. Now, remember this. They sold me this pen. I paid them US dollars. Now I'm raising a bond and I'm taking those dollars back. I'm taking it as a loan, but I have to pay that loan some point of time to those countries, right? Now, this is the whole problem because first, I don't manufacture, I spend, and then after spending, I need more money to spend. So I borrow the same money back from those countries and I spend that money again. And then somewhere, the cycle has to stop. And that's the kind of seriousness that this whole scenario is presenting in front of us. Okay. So, which is why basically the genesis of all this trade war and tariff war, we spoke about this, the tariffs episodes also, that because of all this tariff, now America wants to get a lot of taxation back. So basically what happens is, A, you want taxation and tariffs so that you can earn from there. B, you want borrowings that you can earn from there. C, if none of these two work, you start printing and you start making more money. So there are all the three things negative that are happening from a economic and a fair trade point of view. And ultimately what? It will lead to some sort of a, hard stop, and it will lead to some sort of a disaster of, gigantic proportions. We don't even know what will happen, right? And as a result of which, I think US realized that somewhere the bond yields, as you know, spiked. We talk about that separately. But basically, that's why you had the 90-day pause on the tariff, right? Okay. But see, so much of uncertainty, right? So therefore, gold is moving up. We also explained last year that whole new currency of BRICS, which is coming in, and half the planet is might participate into that and all of that. But of course, USA doesn't want that. But in the meanwhile, the latest news of the last 1 year, new news in this area is the digital currency of China. So they are ready pretty much to trade. Most of the ASEAN countries have already signed up with it. So people are, in some sense, getting ready. People meaning not you and me, people meaning the central banks of the world are in some sense getting ready to gear up if they need to opt out of transacting in dollars. Okay, now let that sink in for a minute. We are probably building reserves, and that's my next point. All the central governments of the world are buying a lot of gold so that they can, in some sense, have a little bit of hedge, a hedge on the global uncertainty. Or if something triggers or if something happens by which we don't have that data, we don't have that information, there's a lot more that our central bankers have, and which is why some of this latest news that you're seeing, this news is not very old. This news came quite recently. India bought about 58 tons of gold. And this is only 2025. And I mean, we are only in the 5th month. Actually, only 4 months have got over. This news came in the 7th of April. The Central Bank of China buying, a huge quantum of gold. African countries are joining the gold buying spree. This is Russia strengthened its gold reserves, the 5th among global leaders. So now you see, all the major players are buying. No, I mean, not only major, the minor ones are also started buying. So everyone's fortifying their position. If something were to happen to the dollar, if the dollar has to have a demise, in the sense, dollar will not disappear, but it will not be the reserve currency. And there are, of course, certain reasons why we will see to understand that better. But this is probably one of the reasons. See, industrial demand and, we believe that Indians are holding gold and Chinese also hold gold. Retail, we don't have the power to move gold by 5% and 10% and maybe 20% in a month. That only these central banks can do, because they are on a buying frenzy. See, these guys are not like retail traders. They are not buying for a 10% and 20% appreciation. They are buying from a much, much longer time frame point of view. Maybe they are going to hold on to this gold for the next 30, 40, 50 years. So their long term is very, very different. And by the way, some of you may or may not even remember what happened in 1991. India was on the brink of bankruptcy. We barely had any money left at that time to pay for our imports, to pay for oil and all of that. So what Indian government did at that time was that we actually put a lot of our gold bars, okay, I don't know the exact number, but maybe you can do a Google and just tell me how much gold was put on the plane to London. It went to Bank of England, and we got a lifeline from there. We actually borrowed money from Bank of England. 1991, crisis in India that happened. Okay, bankruptcy crisis. So gold, as we know, was the metal or the investment of the last resort, or the money of the last resort. And that is also playing on the minds of these central banks, which is why even a Kenyan central bank and the smaller countries of Africa, who are not really on the global economic platform of leaders of trade, they are also buying gold. Okay, just to tell you, I thought it was pertinent. So, which is why there's a lot of interest by central banks in buying gold. Let's move on. Let's go. Let's actually even we have some very interesting data to show you. How much gold has been bought. Now, look at this. By the way, this one picture tells you all. Last 3 years, yeah. This is data as on 31st of December 24. This is 23, and this was 22. Look at this. It's been the highest purchase in the last 75 years. We showed you the same picture last year, but that time this piece was missing, okay, because the data was up to 31st December 23, and now we have the data for 31st December 24. The gold buying has been the same. It's been about 1,000 tons plus. So all the central banks around the world have bought more than 1,000 tons consistently for the last 3 years. And look at the average buying that was happening in the time frame that we have this data from 2010 till about 2020. So this 10 years, this entire block, the gold buying was, let's say, at an average of about this much, about maybe 250, 300 tons a year. But look at this, the average buying has gone up 4 times now. Obviously, there is something that they know which we don't know, right? Which is why they are buying all this crazy, frenzy to buy gold. So let's see exactly who is buying how much. This is very interesting, okay? We have actually got this data. This is also available. Last year also I said this thing. If somebody's interested, we are very happy to share this Excel with you. But please put this Excel. It just gives you a summary. This comes from the World Gold Council. So it gives you a summary of who's actually buying and which country is buying how much gold. Very, very interesting piece of data. Okay, this is very tiny, but I'm going to... Can you do one thing, please? Can you just hide these rows from I to X? So just keep 2024 open. And then you can zoom. Okay. Yeah, let's just hide them. Now zoom. Zoom further so that we can see it nicely. Zoom further. Okay, so now, friends, look at this. Surprise, surprise. Who's buying how much? Okay. Look at this. Just a second, please. Yeah, look at the number one buyer of gold. Poland. Can you imagine? Poland is buying gold. Poland in 24 bought about 90 tons of gold. And in 2025, year to date, they have bought about 32 tons of gold. Okay. Then you, of course, have our India, which has bought about 73 last, and I think this data is still not updated. It says 2.8, but we just saw it. Just last week, I think it came. Which day newspaper was that? 57 tons. I think we will see that picture. But so we just bought about 60 tons in 2025. Okay, China last year bought 44, and this year is buying about 10. But this is just to give you a representation. Oh, Turkey is buying 75 tons of gold last year. There's a lot happening, right? So there is something that they are thinking about. Okay, can you just scroll down a little bit to see who else is buying? Okay, so I mean, as you can see, Ghana, see, I mean, 10, 11 tons of gold last year. Qatar is buying, I mean, 3 tons of gold this year, 10 tons last year. Georgia, Cambodia. I mean, look at what's happening. So everybody is trying to insulate themselves, versus some sort of an eventuality or something that goes wrong. Everyone's trying to protect their little, country, kingdom, what have you, that kind of thing. So there is a lot of interest that is happening. And if you see this little column that we've got, the total changes from 22, okay, go up there. This just gives you how much additional some of these countries have bought from in the last 23, 25 years. Look at China here. Okay, sorry for my notations, but I'm just going to do something like that. Almost 1,800 tons of gold. Okay, China has bought in the last 23 years. This is data from 22. So 2000, sorry, 2002, so 2003 onwards till 2025. And 25 is just 4 months, right? So technically 22 years. India has bought about 500 plus the 50 tons that we just saw, 60 tons that we just saw. Turkey 500, and Poland has bought about 400 tons of gold recently. I mean, in the last 2 decades. So again, just to give you a sense, there's a lot that is happening around the world. And if central banks are buying, obviously they know something more than what we do. Let's come back to our presentation. So central bank is buying. Therefore, gold is moving up. There is yet another very interesting study that we conducted based on the US debt and US GDP. Now, let me just give you a little bit of theory for 2 minutes. Okay. So, let me take you back in time about 1944. So, that was the time there was a system called the gold system. The gold system was implemented. It was called the Bretton Woods system. It was got into place so that the world, which was trading before that in gold, and different countries were doing different things. Somebody's doing gold, somebody's got a fiat currency. Currency, as we know it, is known as fiat currency. Okay, so while all this was happening, America came and said, let's make a gold standard. Okay, let's make it uniform so everybody can trade in US dollars, and we will sort of peg the US dollars or assign the US dollars, and we will anchor them to some value of gold. So everybody's pretty easy, because you see, you don't have to carry, big boxes and wads of gold and, big heavy things. You don't need, in those days, helpers and assistants to carry those trunks of gold and gold coins to trade. You could just carry some pieces of paper, which was so easy to trade and transact, right? So that's the reason, this whole system came about in 1944. Okay. So we are going to therefore do this study from 1944 till 2025 and see what happens. You will be amazed. Okay. Also remember one thing, that before 1944, gold was money, right? And just to make things easier, and USA was already one of the leading economies of the world. I mean, they had got their independence, many years before that. So they were kind of the leaders of the world, and that's what happened. Okay. So now let's go down and let's go to 1944. Okay. So 1944. Now I'm going to use some notations, and you follow my notations. So in 1944 here, gold, this Bretton Woods system was put into place, and gold was based at 35 US dollars per ounce of gold. Okay, 1 ounce, for the ones who are not exactly familiar, 1 ounce is approximately 29 point a little more grams. Okay, so let's round it to 30 for sake of conversation. So 1 ounce is equal to 30 grams. Okay, just for the sake of conversation, it's not exact, it's 29 point something. So $35 for 30 grams. So again, we will just do a little more rationalizing. Can we say $1 per gram? Just, it becomes easy to communicate, you see. So that was the price at which gold was fixed. Okay, and this gold system was brought into place. Okay, now slowly go down till 1971. Okay, now something very interesting happened in 1971. What happened is Richard Nixon was the president at that point of time. And Richard Nixon said, hey, listen, you know what? Let's just forget about all this gold standard. Okay, let's just trade in paper currency. Gold was there as a backing, but now no more, because you see, the problem is the amount of loans that were happening in America was humongous. Okay, go down a little bit more. It was absolutely crazy. Okay, I mean, USA needed to finance its wars and recessions, and basically all of them, you know, and Vietnam War was going to happen in 75. Of course, they didn't know in 71, because, you know, you don't know exactly when the war is going to break, but signals happen a few years in advance. So basically, finally, you know, in 1973, they just ended this entire pegging to the gold system. But now, here comes a very interesting point. So if in 1944, okay, if gold in 1944, okay, so just imagine 1944 here, gold is $35 to 1 ounce, okay, so $1 per gram. So now, as time passes by, if in 1944 I have some amount of loans, and let's say that loan is 200 rupees, okay, for simplicity. If my loan is going to go up, and I have kind of made a relationship with gold as I move, because my loan went up so much, gold kind of started lagging behind. So I said, "Chhod the gold, forget about it." But if I did not do that, then gold would also have risen in value to match the dollar value. Very simply put, I'm repeating this again. Okay, if I had borrowed 200 rupees at that point of time, just example, and the value of 1 rupee was equal to $1. If my loans went up, if my liabilities went up, they would also go up in gold terms, right? Logical, simple logic here. Okay. Now come bring that sheet back. Okay. So, friends, just see what happened. If gold had been around, this is just a study. Okay. So don't get startled, don't fall from your chairs. Okay. Just watch. So, wapas 1944 mein jao. Go up. Go up. Okay. Now stop here. Wait. So let me use my annotations again. See, in 1944, gold was here. 200 was the $201 billion. Okay, that was the loans or the debt of USA. $200 billion. Okay. Acha, in that year, by the way, the GDP was 224 billion. Okay, just for your knowledge. We'll come to GDP later on. But Perry will do this study with respect to loans. So $200 billion was the loans in America. At that time, gold was fixed at $35 to 1 troy ounce, or basically $1 to 1 gram. If gold was still there, if Nixon did not dismantle it, in President Nixon, if he had not dismantled in 1971, 73, what would happen now? You know what is the current loan of America today? 1944 say we will straight away jump to 2025, to current year. So how many years? 56 plus 25, which is 81 years later. 81 years later, can you see the number there? This is the number. Just point your mouth. 36,000 billion or 36 trillion. It's like a humongous number. But very simply put, just look at ratio proportion that we've learned in school, right? 236,000. So 200 has become 36,000. Take a simple calculator. You can use your phone for that. All of you have calculators in your phone. Let's do this together. Okay. 36,000 divided by 200. The answer is 180. The loan of America or the debt of America has gone up 180 times, right? So what was, friends, what was the value of gold at that time? Remember, we said that gold is how much? $35. Everybody remembers that? Gold was $35. So $35, and we multiply that $35 with 180. So the answer that we get is 6,300. Okay. Bring the Excel back. What does this mean? That if gold standard was still there, gold's price should have been 6,300, or I don't know what you see here approximately. You know, I've just done a round figure. This is more like an Excel figure, 6,269. Okay, so this should have been the price of gold. Versus that, what is the price of gold today? 3,000. And what was yesterday's closing? Let me see, 3,240. Say 3,200 was the closing price of gold yesterday. Okay, so this is based on the study of US debt. Now let us study US GDP. So go back in 1944, please. Let us show everybody what was the GDP in 1944. Like we said, it was 224 billion was the GDP. Acha. Okay, now what is the GDP today? The GDP today is almost 30 trillion. I mean, we don't have the number exactly still, but it is close to about 30.51. Let's just round it to 30,000 billion or 30 trillion. Just mathematically, again, you take 30,000 divided by 224, which was the GDP in 1944. The answer that you get is 133.92. Say 134, multiply that by $35. The answer that you get is close to $4,700 or $4,688, as you can see written here before you. You see? Yeah, I mean, if you try and make it even more accurate, I mean, if you believe some of the other numbers that we see, then it is 30,510. That is the approximate number or the estimated projected number right now. If you use that as a multiplier, then you get gold's value at 4,800. So not too much of a difference. But based on GDP, gold should be somewhere around 4,700. What is the gold value today? Again, I'm revising, refreshing for you. It's 3,200. We talk in terms of gold price in US dollars, right? So 3,200. Yeah. So can you see where this conversation is going? Okay, now let's go to the next point on our agenda. Okay, let's come back to our presentation. Let's see that. So from the USA debt and the GDP point of view, we saw that this is moved really fast and furious, right? So let's just summarize, and this is a summary for you. GDP in the year 1944 was 224, currently 30,000, as we said, and approximately the multiple is 134 times. 201 was a debt in billion in 1944. Today, 36,000. So the difference is the 180 times, 180x, and this is a 134x. Okay, so many times it has gone up. So obviously the gold price, which was $35, is 6,300 versus 3,200 of the current price. This is just a summary. Let this kind of sink in. That doesn't mean tomorrow morning you go and start buying gold. But this is just to tell you that, if this gold was still a standard before 1944, gold was money. If gold continued to be money, even now, and which I think somewhere our central banks are thinking like that maybe, see, we spoke about BRICS currency last year, and we said that BRICS is going to be pegged to a basket of currencies. It could be, one of them could be gold, one of them could be silver, one of them could be copper, etc., or it could be a basket of everything. So there's the logic. Okay, let's move forward. Okay, so this is just a quick statistic, just to tell you exactly what is happening. So we spoke about this already at the beginning, that gold is up 27% in today's year. I mean, just year to date, this is the figures to look at. Basically, we are moving up really strong. And yeah, there is a little bit of correction, right? Gold just touched 3,500. It's down to 3,200 right now. So that is part and parcel. It will not go up like a rocket, straight 90 degrees, but it will kind of go up in waves, right? It will go up, come down, go up. It will keep spiking, coming down. But yeah, you already know the answer. It's probably a good idea to consider investment. Okay. So that's all about gold. Now, the thing is, gold has a little bit of a partner, which we all know about. And a lot of times, this partner also has to corroborate, because then we know for sure that, difficult times are here, and therefore uncertainty is at the maximum. And, gold's partner, silver, will also do what it has to do. So generally, silver tends to lag behind. And we always think in terms of silver as it has got a lot of industrial demand. Okay. So there is some data recently, which DSP had mutual fund published, in which they said that, I mean, as you can see, the forecasted amount of, according to them, the forecasted, need for silver in all these electric vehicles is going to be so much. But whether we are going to have vehicles that are electric or hydrogen or something else, we don't know. But anyway, it's nice to know. We will take this fact into consideration. But the more important fact to take into consideration is the fact that if gold has moved up, silver has to sort of follow. So there is a little bit of a ratio study which has been around for many, many years, which I want to now show you. Okay, this slide is doing a lot of talking. Okay, I mean, there's a lot of conversation happening on this, but I'm going to try and simplify it to the best of my ability for you. The point is there is a ratio. Achha, so gold price divided by silver price. I mean, it's very simple. Okay, so silver price, as you know, is $32. Okay, right now, again in dollar terms, and gold price is 32.40, and gold is silver is 32.40, gold is 3200. But we'll just make it simple. We'll just round off to 3200 is gold. Let me just sort of write it here. So gold is 3200 and silver is 32. Just making it simple. So 3,200 divided by 32 is equal to 100. So what is the gold price ratio analysis? Or what is the gold price over the silver price ratio today? $3,200 divided by $32 and we get an answer. Simple answer of 100 is the ratio. Now, historically, 100, this is the ratio, by the way. This is the scale which, sorry for my drawing, but this is the scale which is telling you about the ratios. Okay, this is the ratio on the right hand side. So 100, very rarely it goes. I mean, this is 100 is like a signal of crisis of sorts. Okay, so we are at 100 right now. Achha. Now let's go back into history a little bit. Okay, let's just study this gold and silver price in history. So from 2003 to 2008, what was happening is obvious some sort of period of uncertainty. But when this important thing is the ratio, okay, gold price or silver price. Now this is back history. Okay, historically we are wiser, but we look at that history to try and predict what is going to happen in the future. That is all that is happening here. Simple. So this ratio was falling. See, every day these prices are changing, right? But over a long period of time, if you are noting the price change every day, you will see that there is a little bit of a trend happening. So the trend of the price was downwards, as you can see here. And this was happening between the years 2003 to 2008. Silver moved from $5 to $20. Gold moved from, as you can see, 345 to $973. Okay. When the ratio started increasing, both these started falling in value. Gold from 973 became 723. Silver from $20 became $10. Okay. Then from 2008, remember the housing crisis, housing crash, uncertainty time and all of that. So from October 8 till April 11, all this uncertain time, this period particularly, so gold moved from $723 to $1,563. But gold more or less doubled. Achha, look at what happened to silver. Silver from $10 moved to $48, 5 times. Gold doubled, silver became 5 times. Okay, 2011, more or less stability in the whole world. Everything is fine. Everything is okay all the way until 2020 when COVID hit us. Okay, so COVID hit us, uncertainty again. Oh, by the way, look at from 2011 to 2020. Stable times, good times, 9 years. Gold price was 1563, gold price is 1575. Virtually no change in the price of gold. Why? Because everything is stable, everything is beautiful, nice and fine. World is, proper. The world is not sick. Nobody is coughing. Everybody is in good health. All the countries are in good health. So gold didn't do anything. But look at what happened immediately in like 1 year's time. COVID struck. Okay, gold 1575. Gold didn't move too much. This time, gold went to 1580. More or less, it stayed there. But silver from 14 moved to 30. Silver doubled in this period of. Okay, so yeah, sometimes this kind of thing can also happen. But now, in stable times, till about 22, again, this is a very short period. Yeah, gold from 1600 to about 1600, the same. But silver has fallen a little bit. Okay, but fast forward to 25. So if you look at, ignore this September 22, because you obviously, this data is only there till about September 22, which is here, but we are at March. We can't exactly clearly see it because you see about 25 years of data packed in your screen, but see what is happening now, which is why I've written May here. Gold has moved in 21 to 25, and see it has shot up recently, right? Last 2 years. 1585, or say $1,600 to $3,200. Gold has doubled. So gold has become 2x, right? Silver However, friends, look at silver. Silver was $30 and is standing at $32 right now. What does that mean from silver's point of view? See, if gold is double, what happened here? See, silver moved from $10 to $48. So now, and the ratio right now, like I said, is 100. 100 is like, red flag of gigantic proportion. So the ratio has to fall. This little, it looks a little messy, but this little green arrow is basically saying that the ratio now has to fall. If the ratio has to fall and silver has not moved in price at all, what do you think will happen? The average ratio, by the way, friends, is 60. So if the average ratio is 60 and gold remains where it is at 3,200, silver should become 53. Which means what? 32 to 53. Please, 60-70% ho gaya. If gold moves up to 4,000, because gold is moving at a rapid pace. Remember why? All the central banks are buying gold. Achha, so if the ratio has to remain at 60, then again we take our calculator, 4,000 divided by 60. The answer is 67. That means silver has become 67. Achha, if gold becomes 5,000 and 6,000, my goodness, just look at where silver has to go. If the ratio of 30 has to be maintained. Now, if this crisis is massive, which it is, and look at now this is a little bit of human judgment that we use. If dollar itself is shaking, if dollar is in danger, what might happen is we might see a repetition of what happened in 2011. The ratio might go down all the way to 30. So if the ratio goes to 30, friends, and if gold remains at 3,200 where it is, silver should hit a minimum of 107. And if gold moves to 6,000, which we saw while, if gold moves to 6,000, if the ratio has to go down to 30, my goodness, silver has to go to 200. You see? I mean, this is insane. No, I mean, these are all just analysis, but at the end of the day, we don't know what's going to happen even 10 minutes later. But I personally think, and I've been telling all friends, I think maybe it's a time to actually have a sufficient amount of percentage allocation in your portfolio. You must give space to gold and silver in your portfolio. And that's what is the sum and substance of whatever we are saying today. Okay. Okay, just come back to the previous one. I just want to, just clarify. See, don't get enamored, by the way, when you see all these numbers, these are not targets, by the way. This is just a proportionate study. It's just mathematics. But obviously, mathematics is pointing to this kind of a number of silver 100 and silver 200, which is like 3 times and 6 times. So just imagine if silver's prices are like right now in India, 3 times and 6 times means how much? It's crazy. But it doesn't mean that it's going to happen like in 2 months or 3 months. Okay, this is not like the rally of small cap and mid cap and like fast and furious kind of a rally. It will not be like that. The world will move a little forward, look behind, move 4 steps forward, take 1 step behind, just see what's happening, and then again do the same process. This will take time. It may not happen in a major hurry. See, these are things that intrinsically don't have any value. Is otherwise what? It's a piece of metal at the end of the day. But I just wanted to again amply clarify, this is not a target. This is just a mathematical number. But who knows, what numbers will shape up. And I'm of the opinion that if actually America does what it does and continues to do what it's doing, then I think we may see some of these numbers becoming a reality in maybe the next 3 to 5 or maybe 10 years. Okay. So with that, what I want to do is I want to, I've spoken a lot more than my usual 30, 35, 40 minutes, but that's, the submission of gold and silver part 2 for you. And we'll, of course, meet again in 2026, a year from now, and we'll talk about what actually transpired between this year and next year in terms of gold. But for now, let's sort of put an end to the session.